Good day, fellow investors. One of the most common questions that I get is whether to take a fixed or adjustable mortgage rate. Let's discuss the details because that is a huge financial decision that you make once or twice in your life but can have huge consequences if not done properly. I am doing this video because I've got this message from Frederick discussing his situation, and you can pause here, and I think that many of you looking at the same question have been or are in a similar situation, fixed or variable interest rate. They are telling me interest rates will go lower, so better take a variable rate and then see what can happen with interest rates in the next few decades. This is the situation from Frederick. Loan 275k, fixed rate is 2.9, this is Belgium I think, adjustable 1.5, if it returns to the last 20-year average, and of course a fixed would cost 50,000 more over 30 years. I hope to give you the added value here, the things that your banker will not discuss with you but are key for making such a big life financial decision. Those are predictability of interest rates, inflation, the world we live in, how to make a decision, and then also examples where we calculate what happens and what's going on. Let's start. If you enjoyed this, smash that like button. Let's start with predictability of interest rates. 30-year mortgage. And 30 years are hard to predict anything in finance. But if we look at Frederick's, they're advising me to get variable interest rate for the following reasons. They expect that interest rates will decrease. Currently the rate is higher. Over the last 20 years it was 1/3 of the current rate, and interest rates will likely go lower. That would then cheapen the cost of my mortgage. What will interest rates do? We have the euro, not more the Belgian franc, and how can we invest now? When somebody tells you to get a variable rate for the following reasons, Charlie Munger says, show me the incentive and I will show you the outcome. And then we go to The Big Short. If you remember these scenes with mortgage brokers, and there is even the chat there. You own a boat, so how many of these are adjustable rate mortgages? Well, most, says the mortgage broker. Yeah, I'd say about 90%. The bonuses on those skyrocketed a few years ago. Adjustables are our bread and honey. Why? Because with adjustable, whatever happens in the financial market, the bank wins. With fixed, the bank can lose big because they cannot borrow money with 30-year fixed and then give it to you with 30-year fixed. That's a little bit difficult for them. Or they have unrealized losses and then makes things look ugly. So yes, anything can happen. Jerome Powell just cut rates, and if that continues for the next 6 months, then variable is the way to go, but nobody can predict interest rates. And if we go to the 30-year mortgage in the US over the last 25 years, yes, now it has been declining, but is it possible to predict? If it goes to the average of the last decade and a half too, then yes, it will get much cheaper, but nobody can guarantee you that. Here, for a long time, it was much higher. If we go more back into history, it was 7%. It went up to 20%. So the variable might even go higher, and then you have to calculate what would happen to you if interest rates change. And when it comes to interest rates, Buffett says everything. I never like to play the game of predicting rates because we don't know what the average interest rate will be the next 10 or 30 years. Any changes in stock prices may occur. The market might even go down by 50% or more. And he also claimed that pundits who like to predict markets actually reveal more about themselves than about the future. Warren Buffett tells you it's impossible to predict interest rates. Thus, we have to leave that factor as unknown when it comes to predicting interest rates. When you take a mortgage, unknown, anything can happen, has to be your answer there. That's it. And then you can build on that. Then you can ask yourself, okay, what is the chance of interest rates being higher? Well, it is your home. There is no what is the chance. There is, can I survive it or not? If not, you don't take that risk on interest rate changing on your home. You make the calculations. Because the world we live in is one of high debt levels. The government can solve that with inflation. But if you lose your job, if this happens, and your variable goes to 10%, then things look ugly. And the only solution for these debt levels is inflation, and that's something we have to keep in mind when it comes to our mortgages. It is impossible to predict, and that has to be implemented in the decision making, and therefore you have to think in scenarios. The best way to think in scenarios is to go through them. I have found a great calculator, mortgage calculator on Bankrate. You can check it out there. It's free, it's nice, it's fast, and I have taken 300,000 loan, 30 years, interest rates 5%, monthly 1,610, same interest rate 4%, monthly 1,432. Okay, this is cheaper, you say, but let's play a scenario when things change. This is how a mortgage loan is paid off. First, you pay the interest, and then slowly you start chipping off that principal until you pay the last part of that principal after 30 years. But with the fixed mortgage, you always pay the same. You are sure that you will always pay the same, but at first the principal paid is smaller. The variable rate, the payments are lower, the interest rate is lower, thus the principal paid is bigger, and therefore the principal paid after 10 years is 66,000 on a 300,000 loan. Now, we have to play in scenarios. Let's say we are in year 10 and the interest rate goes from 4, the variable one, to 10%. It was 4. The payment goes to 2,256 because that's what left on the principal with the 10% interest rate, and the monthly payment breakdown goes from 1,432 to 2,256. And that's something you have to calculate. Okay, how would I feel if that happens in 10 years? And then also scenarios, fixed, it costs a bit more but gives safety and predictability. So what is more important to you? Can get much more expensive if rates rise, the variable of course. And I think that you will get even lower rates and higher rates in 30 years. Impossible to predict. What did I do? I took 2 loans in my life and always fixed. So 2016, we took a fixed for 20 years at 3.55. The monthly was 1,368. My salary net was 3,800 back then. Now if I had still the same job, the salary would be 550. And my payment would still be 1,368. So yes, I would have lost money because the variable would still have been cheaper over the last decade, but you never know. If rates now go to 6%, the payment, this one, would be 2,000 and I would be losing money on that. And the key factor here is that this is a decision that you are making over the next 30 years. Anything will happen in the next 30 years, anything can happen, and the key is that you know, okay, if anything can happen, can I handle it in the various scenarios? When it comes to Frederick here, the decision for the next 30 years, 60K is the cost to sleep well forever, no risk on your home, inflation, you have everything predictable, and if you look at the difference, or 50K, is 1.6 per year, thus that costs you 138 per month. If we take this into a value investing perspective, value investing is about no risk, so value investors would take the fixed, just to avoid these kind of headlines where thousands of families are at risk of losing their homes after 20 years of paying their mortgage. My perspective, I would take this one because I don't want to risk on my home, and I don't know where interest rates will go. I know that there is inflation. Over the last 20 years, rents doubled, and that will continue to be so because governments are printing money. In the process of value investing, don't take risks on home. Take risks elsewhere, businesses, whatever. Because, as we said, we can't predict rates. Now, interest rates in Europe, I think that average rates for 30 years, around 4%, are free money. So in Europe, I would definitely take a 30-year free money mortgage loan, because if inflation is 4%, you get free money and you never know what will happen with the euro. In the States, the 30-year fixed is 6%. Of course, it would be much nicer at free 4%, and those who took a variable here or here are now rethinking it. So that is the risk. I cannot predict it, but you have to calculate what are your payments, what are your possibilities. And the trick is that with higher interest rates, home prices went up. Those should had gone down, but that didn't happen. Thus, something is still keeping them up. So everything is twice as expensive. You have higher home prices and higher mortgage costs, and you have to make the calculation. The cheap times of buying real estate when we all bought have unfortunately passed. So the conclusion is, decide whether you wish to take any risks on your home, personal decision. So see how it fits you, consider all the following scenarios and how you will manage them. Inflation stay low, rates stay low, okay, one scenario. Inflation picks up and we have higher for longer rates. You can lose your job in a hyperinflation environment. Do you have the financial flexibility to manage whatever is thrown at you? Make the calculations, go to Bankrate, calculate whatever, and discuss that also with your spouse. It is an impossible decision if you take a fixed mindset. Make the scenarios, see what's best, and see how much risk you want to take in your life. So this is a video I wanted to do to answer all of those, asking the question whether to take fixed or variable. As I said, in Europe I would go for the fixed now. In the States, it depends on you. It's, let's say, fairly priced, is not cheap as it was at 3.5, 4%, even lower. That was cheap, ridiculously cheap mortgages. Now those times have passed. Will those times come back? If those come back, then you know what to do. Simple. If those don't come back, well, that's life. You can't always have everything. So do other things, find what best suits you, and that's about it. Keep being a value investor. For that, subscribe here for the value investing process.